On today's episode, I'm joined by Assistant Manager in our Norwich office, Dom Smith. Welcome, Dom.
Afternoon.
What we're going to be talking about is a subject that's very close to my heart, and I know something you've worked on for a number of years as well, is business structures, especially for those businesses starting out for the first time or quite young and small businesses. Predominantly, I think we'll start on talking about the key differences between incorporated and unincorporated businesses, which is a question we get a lot, certainly from businesses starting up for the first time. And then I'm sure this will evolve into discussions around tax and risk and all sorts of other things. But Dom, I don't know if you want to start out really by explaining the differences when you're talking to clients about that unincorporated versus incorporated, limited companies versus sole traders, shall we say, initially, what the main differences are.
Yeah, so I guess there's a few very broad categories, right? So there's simplicity, there's tax, there's risk. And these are three things that you're mostly going to be talking about. Now, I think people, when they think of limited companies initially, they kind of assume that this is some almost magic trick of like, oh, if I set up a limited company, I'm automatically going to be better for tax. But actually, that really might not be the case, particularly as tax rates change constantly. So if I'm talking to a client initially, you generally start speaking about what's their actual personal position and what's their income, right? So if this is the only thing they do and they've got no other income at all, then clearly we're already onto a winner in terms of simplicity here, and potentially the sole trader then becomes more of a realistic topic to talk about, because ultimately, if their income is below the basic rate threshold, then what's going to be the driving factor to actually need or want a limited company? If you're a sole trader, you're just going to be taxed on your profits. Mm-hmm. If you're earning less than the basic rate band, then there's no huge amount of tax planning you can really do about that if you've got no other income or nothing else going on. And the creation of the limited company, as we know, is going to tend to come with a bit more admin, a bit more in professional fees, and just general a bit more complication.
Because a limited company, it's a separate legal entity, isn't it? And so you would, as a business owner, typically pay an accountant to prepare accounts for that company, but also file tax returns for that company. And that additional compliance, I guess, adds some cost to running a business and managing a business. Yeah,
you've got two sides to it. If you act as a sole trader, the difference between a sole trader and you is not really anything at all. You earn some money, you pay some tax on it. But as soon as you incorporate a limited company, you've then got two things. You've got a company, and the company is going to need its own accounts and its own tax, and that is separate from you, regardless if you own 100% of it. That company is its own thing with its own money. You have to extract money out of that company in the most efficient way possible. Yeah. You're probably going to need some help and advice to do that, to make sure that actually by the time the company's paid its tax and you've paid your tax, that you don't actually end up worse off, which is a distinct possibility if you try to kind of wing it alone and not have a full understanding of what you're getting yourself into by setting up the limited company in the first place.
So when you have a small limited company as a business owner, you're effectively paying tax twice at that stage, albeit on lower levels. But I guess in terms of whether it's beneficial from a tax point of view, it is looking at the company route is the company will pay corporation tax on its profits, and then as the individual, you pay tax again to extract those profits personally. Yep. Whereas the sole trader route, you are the business, as you said earlier, and therefore all the profits are automatically subject to income tax and potentially national insurance. And that's the key calculation, I guess, when you're looking at initially from the outset which route to take from a tax perspective.
Yeah, and ultimately there's the basic rate threshold. I mean, as we sit here today, it's around 50,000, but we know these things can change quite quickly and quite a lot. And if you get to above that basic rate threshold, you can really get trapped in some nasty kind of tax brackets. You could be paying a higher rate of tax, which could be around 40%, and you could also start to lose your child benefit, for example. Now, if you're paying a higher rate of tax and you lose your child benefit, your effective rate of tax in that little bit of your income is ginormous. Yeah. If you earn more than that, you could start losing your personal allowance, which is a tax-free amount that nearly all of us have. And again, if you factor all those three things in, you could be paying a really, really high marginal rate of tax. And if you're a sole trader and you are fortunate enough to be doing that well, you really have no choice about it. You're going to pay a huge amount of tax on your profits, and there's nothing you can do. the advantage of the limited company is you actually have that flexibility to basically decide how much income you're going to be taxed on personally.
Yeah.
Now, decide is obviously a bit misleading because you've got your own expenses to pay, so you're going to need to take some money. But you don't have to be taxed on all of it. The company's already been taxed at probably a lower rate, around, call it around 20% as an average. And how you extract that money is then going to differentiate between the sole trader and whether actually, purely from a tax point of view and forgetting any other perspective, whether you're better off or worse off.
So, as an example, I guess a company or a business, let's call it, and we're not decided to incorporate at this stage, but a business could have varying profits because maybe in one year you have a big outlay, you buy some machinery. In another year, you have a really good contract that comes in that doesn't repeat. And so the profits of the business can spike or can fall. And if you were a sole trader, those profits would be subject to income tax. And in an isolated year, could push you into losing your child benefit, losing your personal allowance, paying higher rates of tax. Whereas if your actual income requirements are consistent every year, you pay corporation tax as a company on the profits as they fall due at 19, 25, whatever the percentage rate is. But the amount you draw out of the company, you're in control of. You can pitch that at 50k if that's the relevant point for you and pay tax consistently each year in a more controlled way.
As advisors, that is essentially our job, and essentially what we do all the time is we look at, if you're in a limited company, we want to extract that money out of the company over as many tax years as possible. It's fairly, you don't have to know too much about tax to know that, if you get paid £50,000 in one tax year and £50,000 in the next tax year, you're going to pay less tax across those two tax years than if you had £100,000 all in one tax year and nothing in the next. Yeah. And you're correct to say, if you're a sole trader, that could be the way. You could have a really amazing year one year and just pay loads of tax, a really high rate of tax. The next year things could be not so great. But that tax is gone. There's no opportunity to get that back. That is what it is. A limited company, you would look to say, well, actually, how much of this, I've had a great year, how much of this do I actually need right now in terms of my living expenses, but also what it's worth to me in terms of how much tax I'm going to pay on it. And actually, maybe I'll take less because I don't need that much right now. I can take this amount, pay less tax on it, and take some more the next year instead, and spread that out over many years at an average rate that's lower.
But what I'm hearing here, and I'll ask you a question I already know the answer to, is that this is not a simple, I have a limited company, therefore I am tax efficient. You need good advice alongside your limited company, don't you?
Yeah, absolutely. There's a limited company, I think I sort of alluded to it at the start. I think people sort of think that, okay, if I'm starting a business, I must need a limited company. That must be the way to go. And that just isn't the case. It may well be, and it is for a lot of people for other reasons than just tax, but ultimately, if you don't fully understand or don't have an advisor that's going to proactively advise you on how I'm going to incorporate this company, how I'm going to get money out of this company, then you might be on not just to equal a sole trader, you might be onto a loser. You might be you potentially could be worse off. In pure tax and monetary terms.
Because ultimately, as well, of course, extracting money from a company sounds quite straightforward, but there's a number of ways of extracting money from a company: salary, dividend, paying yourself rent if you own the premises that the business operates from. And whilst there are typical strategies around that area of a lower salary and then dividends to top it up, the allowances and rates around those types of strategies has changed in recent years as well, hasn't it? And so, we've very recently seen a change to the national insurance rules, which may well change the amount of salary a typical company owner may take out. But again, part of our job is to advise on the optimum level of salary, dividend, and there are other considerations, state pension entitlement, things like that as well, aren't there?
Yeah, of course. And that again is probably one of the key points, is that it changes so much.
Yeah,
the UK seems to be permanently in a bit of a state of flux in terms of what's happening with the economy, and there's been a lot of various global shocks recently. It's meant that there's been a lot of tax changes, and all those tax changes have implications not just to whether the limited company or the sole trader might be better for you, but actually, even if the option of the limited company is definitely the one for you, actually what you do each year, and actually the level of salary, the level of dividend that you take, as that tends to be the typical structure, will quite frequently change, and indeed it's going to change as we sit here for the next tax year that we now enter into. And there are other considerations. If you are in employment, you are already paying your taxes. You're already qualifying probably for a state pension year as long as you're above a certain threshold. If you're in your own limited company, you have to make that happen, or your advisor has to help you to make that happen. So you might even look and say, oh, well, wouldn't it be better for tax purposes if I did this and maybe just took loads of dividends? And perhaps it would, perhaps it wouldn't. But when you start factoring in, well, have I had enough qualifying national insurance years to qualify for a full state pension? Again, that threshold can change and has changed. And we might need to look at that. And there's bigger pictures here than just how much tax am I paying in this one tax year.
Yeah, because national insurance is a key point as well. And ultimately, I guess typically you would think, well, paying tax in the company and then tax again as an individual, that sounds expensive. But ultimately, when you are self-employed as a sole trader business, you're subject to national insurance, class 4 national insurance on profits. And I guess when you're looking at comparing the tax benefits of incorporating a business, that's often where the savings can be made. You can control that split of income between salary and dividend in order to pay the right amount of national insurance, can't you? Now, that will potentially cost you a little bit more in income tax, but overall it's marginally more beneficial to do that. But still only marginally, because many years ago, dividends were tax-free. Now they're not, and the dividend allowance is minimal at £500. And so ultimately that gap has narrowed somewhat between the automatic assumption that a limited company is beneficial from a tax point of view. I think as you started out on, that's not necessarily true anymore, is it? Not
at all, no. And I think that's going to be the case for the foreseeable, really. I don't think we would envisage that particularly changing greatly. Probably as recently as, say, 5-10 years ago, it would have been a much more straightforward calculation to say, well, if you're earning in and around or slightly more than the basic rate of tax, or you have multiple sources of income, almost certainly you would be better off having a limited company from a tax point of view straight off. But these days, unless you have actually an income that is, I'd say, reasonably quite well over the basic rate threshold, really, or you have several sources of income which are unpredictable, it's only really those scenarios which you could look at and, fairly confidently say, yeah, you're definitely going to be better off being a limited company. Yeah. The gap when you are quite close to the basic rate threshold is very narrow indeed. I mean, it's not as drastic as it sounds. I think when you start to get comfortable with the idea that my company pays corporation tax, but then I have to pay tax to take it out. Yeah. That sounds dreadful. Yeah. Right? It sounds awful. Like I'm paying 2 taxes. That must be loads worse off. Yeah. But actually, it isn't for various reasons. Yeah. I mean, one being your own salary is deductible from your profits in a limited company, for example, which is quite a counterintuitive sort of thought. But that means that actually the gap is pretty close when you are within the kind of basic rate range. But yeah, ultimately, if you are within the basic rate range and you don't have multiple sources of income, then you really have to consider, why would I want a limited company?
Yeah, agreed. And also, you touched on at the start, aside from taxes, which is obviously our day job to talk to business owners about their tax liabilities and how they can make them efficient. But we talked about risk as well, and that's another consideration, not for every type of business, but of course a limited company does come with limited liability, which does mean that, as we touched on from a tax point of view, it's a separate legal entity, but that does have some potential benefits, doesn't it, when you're talking about trading risk and how that might fit into whatever your trade or sector is?
Yeah, completely. I think this is perhaps the reason why more people are tempted into going down the limited company route, even if the tax benefits of that are marginal or non-existent, is very much that if you are a sole trader and you're running a business and things aren't going well, you're not making enough money, you have debts, perhaps to suppliers, perhaps to HMRC, whoever it may be, there is no protection there's no difference between you and your business. So ultimately, suppliers and creditors, people you owe money to, they can, for want of a better phrase, come after you personally and your personal assets, your house, your car, your money. Yeah. The limited company is limited liability, which sort of does what it says on the tin. It is limited to what the company owns. So it gives you, I guess, a platform a bit to perhaps take a risk, start a business and know that if it does fail and you ultimately end up in a position where you owe people money and you can't pay them, they can only come after the assets of the business. Now, obviously, it isn't quite as straightforward as that. It's we're not talking about you can't just go and be fraudulent. It's got to be a genuine attempt at your actual business. You can't carry on trading and taking supplies from people when you can't pay them, etc. So there's basic rules around kind of decency in law, but ultimately you do have a level of protection there, which means that if the business was to fail, your personal assets won't be affected.
Yeah, I guess it provides peace of mind. I think, legally speaking, that veil of incorporation, as it were, can be lifted if you are seen to be fraudulent or acting outside the good standing as a company director. So there is a risk there that if you want to use a limited company to go above and beyond, then you could be held personally accountable. But also, it's worth understanding that, of course, your liability to the company is limited to any investment you've made. If you've subscribed for shares, then the value of that shares is not repayable to you first. You would not be a preferential creditor. If you've lent money to the company, as many new business owners do by way of a director's loan account to instigate initial cash flow, that money would also be well down the list in terms of which creditors get paid first. So your exposure, I think, at that stage is limited to the money that you have lent or invested in the company. You would not be paid back first. However, yeah, absolutely, if you're doing everything you possibly can to make that business succeed and you're just unfortunate enough that it doesn't, liability would be limited to the money that you've invested or lent to that company. But it's worth understanding that because, as you say, for some sectors in particular, that's really important. For others, they will need insurance by definition, and therefore that will cover any kind of risk, really. But there is certainly an important factor that many people choose to pay a little bit more when it comes to professional fees to have that limited company in order to provide that protection.
Yeah.
I guess another couple of business structures we haven't really touched on yet, and we will just cover in summary form, really, is around partnerships and different types of partnerships. Now, a partnership ultimately is a collection of sole traders in business together, isn't it? And so the tax works in a very similar way, I guess. Yeah,
the tax is almost exactly the same, other than it's split between you, essentially. So if you do have a business partner in mind, if you're looking to start up in business, then you still have those two options. Fundamentally, it's broadly going to come down to the same things, right? I mean, if the partnership profits and it was just two of you, you're going to be looking at, okay, well, perhaps we earned, say, £100,000 in our partnership. It was a really good year, but it's going to be 50,000 in that case between you. Mm-hmm. So under current rules, you're still a basic rate taxpayer. You're still, from a purely personal tax point of view, probably going to be better off as the partnership in this case. Yeah. But you do have other options. You could still go in as a limited company. So if perhaps one of you has more than one source of income, and perhaps one person earns more than the other one. So one person says, actually, I don't want to have all this profit lumped on me when I can't choose it. I actually want to have some choice over it. So perhaps you might go in as 50-50 shareholder and structure your company in such a way as you can choose how and when, probably crucially in that case, to pay each other. Yeah. And the other option is the LLP, which is a bit of a strange hybrid in that you have the limited liability of the limited company, but your tax position is the same as the standard partnership or sole trader, where you are just taxed on profits. Yeah, it tends to be popular for professional practices where they want that limited liability that a company would provide them, but they also want very flexible profit sharing arrangements. So typically with a limited company, and this will bring us on to another topic I just wanted to discuss with you about shareholdings and structures, but typically with a limited company, the ownership percentages and therefore the flexibility to pay out differing levels of profit each year are somewhat restricted. Whereas with an LLP, there's a lot more freedom. It can be deemed to be related to or connected to your input into the business and other factors. Partners can be remunerated in different ways each year, depending upon a number of different factors. But with the LLP, you also keep that legal protection as you would do with a company. So hence it was, I think, petitioned some years ago by the professional practice sector. You see lots of accountants and lawyers, architects and those types of organisations that are structured as LLPs for that benefit. Yep. Now, I know there are also some very effective tax strategies in terms of ownership of business where LLPs can be used in terms of succession and such like. And that's a topic which
neither of us specialise in, but is something that I would like to sort of pick up in the future on another podcast around planning for inheritance and such like. So we will certainly come back to that topic. But I think from an LLP point of view, it's certainly something you need to take advice on. As with all these things, we touched on limited versus sole trader, tax advice. When it comes to business structure like this, advice is really important. One other sort of topic just before we move on is with regards to that limited company, shareholding arrangements can be used to bring family members in or business partners. And that is an area that seems to become more and more common in recent years with regards to different classes of shares, which HMRC seem to accept these days. But how does that work in practice, where you might have a family business, husband and wife, and maybe an adult child that are all involved as shareholders of the business? Is it as straightforward as it seems that they each have a third, therefore they each need to be paid a third, or is there more flexibility with that?
There can be flexibility with it. I think the start of these conversations is always more towards the practicalities, right? Of what do you actually want, right? Because usually you don't want to let the tail wag the dog as it goes. You would speak to the family members and say, okay, what do you actually want out of this? What should husband and wife be earning? What should son and daughter be earning? Mm-hmm. What do you want from this? If they all say, actually, this is we want this equal all round, then you're probably not going to do a lot. When I say equal, that's in regards to percentages proportionally. So if perhaps husband and wife have 50 and a son has 25, a daughter has 25, if that was the example. And when they pay dividends, they're going to get those proportions, and that's it. If that's what they want and that's what they think's fair, then you're going to stick with it at that. But if they want flexibility, they're going to need to have a look at some company secretarial work that relates to the actual rights of those shares. So typically the shares when you set them up will just be pretty straightforward. They will be entitled to a dividend. They will have one vote if there is a vote at a meeting. Mm-hmm. And what that essentially means is, okay, the directors decide to vote a dividend, if we go back to that, and that dividend is split on your percentage. So in our example, it's 2,500 for the son or daughter. If you're going to want to actually have more flexibility, you need to write into those dividend rights that the dividends are payable at different times and different at different levels, and they would usually be different classes. So like you said, we typically see like alphabet shares. So people might have within a family perhaps A, B, C, D shares, and you might be able to say, okay, we're going to vote a dividend, but we're only going to vote it for the A shares, or we're only going to vote it for the C shares. And that gives you then the flexibility to say, actually, we want this person to earn this much, we want this person to earn this much. And if that is what someone wants, and actually if there's multiple people involved, often it is going to be the case where differing levels of income are going to suit different people, rather than just this blanket, okay, a dividend gets voted and you all get your percentages.
Yeah, and I think what we see sort of day to day, really, these are much more common, these alphabet share schemes, is that from a company law perspective, absolutely, to set a company up or even amend an existing company to bring in new classes of shares is perfectly fine. But from a tax point of view, there is still that risk lurking in the background, albeit as somewhat reduced in recent years, that is that person earning that dividend salary, whatever it might be, earning that because they've earned it through the business or through their connection to somebody else that's running the business. And so again, advice from a professional, if you're looking to go down the alphabet share route, is really important. And I think that's sort of where we do come into our own in terms of that balance and making sure it's right for each client, and those that it's not right for, that we're advising accordingly. I guess just one other point when it comes to sort of the structure around the limited and sole trader. You don't make your choice and that's you forever. You can change these things. For example, you could start as a sole trader and pay your tax at the lower rates. And then as your business grows and expands, actually a limited company in year 3 or 4 may be more suitable. So you can convert.
Yeah, absolutely. And I think at any point, ideally you get the right advice at the start, right? You don't try and wing it. You just get to the point where you're like, okay, I'm comfortable that I'm a sole trader because, and it's a good reason. I'm a sole trader because this, because that. I'm a limited company because this, because not because Dave down the pub told me, not because I saw this influencer on Instagram who does the same thing as me. Yeah. It's because you've had professional advice and you understand this is why I'm a sole trader or this is why I'm a limited company. But yes, ultimately things can change. And to be honest, if you've got that start bit right and you actually understand why you did what you did in the first place, then you'll probably have a good understanding of why you want to change, rather than it just being it shouldn't just be a random thing that happens, right? It needs to be, usually that reason, as you alluded to, is going to be something like growth. It's going to be something like the business earns much more money than it used to, or perhaps I have another source of income that I didn't used to have, and therefore actually I could do with some more flexibility over how I actually personally get my income.
Or risk, the legal protection might have increased.
Yeah, exactly. Yeah, if you're doing more work with bigger clients or more risky clients, perhaps the insurance situation with what you do is perhaps won't exactly cover the risks that you've now taken on, then sure, maybe that is now a good reason to incorporate that didn't exist to start with.
Yeah, agreed. I think there's quite a lot of topics that are sort of springing to mind here that almost dovetail in with what we've been talking about and spin off away from them, and probably grounds to come back and talk further another day. But certainly when you talk about things like company vehicles, benefit in kind rates, the tax that can be recovered on certain vehicles within a company versus the tax treatment on a sole trader, they're very different, aren't they? Because legally speaking, as you said, the sole trader is you. If you have a vehicle going through the business and you use that 50% for business, then you claim 50% of all that vehicle costs against your tax. Whereas in a limited company, it's not like that at all, is it? And it very much depends on emissions and carbon footprint and such like.
Yeah, absolutely. I think the private element, right, is where people can really come unstuck with the sole trader side of things. So if you're looking to get a car and you're looking to say, okay, well, this car, realistically, in terms of practically what happens, I use this for business and I use it personally. It's just my car. The chances are, that actually quite a big percentage of that car and all the costs that come with it are going to be personal, and you're going to have to say so when it comes to doing your taxes. And that means that all types of tax allowances, whether that be the purchase of the car itself or the running costs that come with it, are going to be restricted to X% that relates to business. So actually, if you don't really use it loads for business, it's mainly a personal car that you sometimes use for business, the amount of tax relief you get is really heavily restricted. In a limited company, it's a bit more all or nothing, right? It's like, is this car available for private use or not? It doesn't matter whether you use it 1% or 99% private. Is it available for private use? And if it is, it's a benefit in kind. It's no different to being an employee and getting a company car. It just happens to be your company. And you will pay a bit of extra tax and a benefit in kind rate. But actually, if it's heavily used personally, you could well be better off by having it through a limited company, because you're not restricted by the amount of personal use that's involved.
And the key factor is, as you say, not personal use. It is the emissions of the vehicle, and hence why we see more and more people talking to us about electric cars and hybrid cars and routing those through their limited companies. And I go back to your point, the tail shouldn't be wagging the dog here on this, but ultimately, if you do have a limited company, there are opportunities with the right advice to to lease or purchase the right types of vehicles. But again, the key point here is these things are changing all the time. We are in the midst of seeing a change to the rules on pickup trucks, for example, which used to be very popular. Lots and lots of people. Those rules are changing. The tax rates on electric cars, hybrid cars, all sorts of cars are changing and will continue to change. So again, there are opportunities here, but it's about getting the right level of advice, I think, at the right time. I think for me, there's sort of quite a lot of content in there, and I'm conscious that probably we will come back again in the future and talk in more depth about some of these specifics. But at this stage, I think that's a really useful overview of the differences between limited company, sole trader, and a little bit about partnerships. But just finishing off by, I guess, talking about the types of clients that you deal with and where they tend to lean on this topic. Do you see mostly people go for the limited, or is it a bit of a mix, or what sort of discussions have you been having with your new clients recently?
I think I mostly see people go for the limited. And now sometimes I think that's not always for the right reasons if they've not come to us right to begin with, because I think sometimes people will get a bit carried away with thinking, okay, well, it's a new business, I must have a limited company. And then they'll set up a limited company and they'll maybe rock up a bit later and say, okay, I've got this limited company, what do I do with it? But when you're seeing people right from the start, even then people tend to lean towards limited company. I think it's the I think it's the limited liability side of it that tends to just tip people over into thinking, well, actually, if the if the tax position is going to be marginal, or perhaps better if I do really well, and the professional fees, okay, it's a bit more admin to do. Actually, the limited liability is probably worth. Just to give me that peace of mind that if anything does really go wrong here, and it's not something that's maybe some sort of disaster that's insurable, it's perhaps just a genuine business failure. I've got that blanket of sort of protection that the limited liability offers. So that is what I think I tend to see mostly.
Yeah, absolutely. I think I agree. We've got some really good sole trader and partnership businesses, but we always keep that topic of when is the right time to convert over to a limited company on the agenda. And like I touched on earlier, I think these days the incremental difference is so small, but ultimately it's still something that should be considered and monitored for all businesses. So certainly something that everyone should take advice on. Yeah, well, that was fantastic. I think there was lots and lots of content there, and hopefully it was really useful to everybody listening and watching. So thank you for your time, Dom. I really appreciate you joining me today.
Thank you, James.
Cheers, and thanks everyone for listening and watching.